A very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coughlin, Chief Currency Analyst. Really looking forward to taking us through the session. Don't forget the normal explanation that as I'm talking about different entries, exits, instruments, different opportunities potentially in the market, remember this is all from an educational perspective. Those of you who are regular realize that it's not a signal trading service. The idea is you look over my shoulder, someone with a professional trading background, you see how I go about making trading decisions, and hopefully that will improve or give you a greater understanding of why markets are moving in the directions that they are moving. The things we'll be looking at today, we'll be looking at the Ecb Rate Meeting on Wednesday. We're going to be specifically looking at how to trade that. And then I'm going to be looking at why the Bank of Japan looks set to keep the Japanese yen weak. I'm also going to explain to a few things about the Japanese yen. Also what's going on with the Aussie and the New Zealand dollar, because we're seeing both of those gaining. We will be looking at the euro, particularly the issue that the ECB are taking, as well as oil, gold, and stocks, and what to do with geopolitical risk fade. So we've got plenty to cover in the session. I'm now going to go over to my charts that I use as part of my role with Financial Source as a trading analyst, and I'm just going to show you what's going on. Right. So first of all, let's just see a look around markets. Stocks have been selling off. We're starting to see some dip buyers, particularly looking at German Euro stocks, FTSE 100 find some dip buyers. These levels are quite good for medium term. One index that's very interesting is China's 50 index. Now, there are risks involved with this, but risks can be quite nicely managed. You see this demand level around that 1400 region. That's strong. You can see buyers last time in this area really took price rapidly higher. The People's Bank of China, unlike other central banks, are cutting interest rates. Why? Because they want to help support China's economy. Do you see this drop in China's 50 index? You see last year it fell around 30%. That's around a 30% fall. So the People's Bank of China wants to make conditions easier for Chinese companies. So that's where they're cutting interest rates. Remember, if interest rates are cut, that means loans and existing debt becomes less expensive to manage. It means interest rates are lower, so consumers have more disposable income. That stimulates the economy. Secondly, China has a number of pro-growth policies directly and deliberately to stimulate Chinese growth. It has some large infrastructure projects, all of which is broadly supportive for China's A50 index over the medium term. So buying here at market makes sense from a medium term perspective, and stops can be placed fairly tightly underneath that 13,200 region. Now, why are stocks selling off? This has largely been on that geopolitical crisis. Now, do you notice how European stocks have had more falls? To see the German DAX, Euro stocks, FTSE 100, to see how their falls have been much more pronounced than the falls in the S&P 500, the Dow, and the NASDAQ. That's because America is naturally more shielded from this Russian-Ukraine crisis because of proximity. Germany, Euro stocks, FTSE 100 are all much closely linked to Russia, and the Eurozone has many strong links with Russian trade. So a slowdown in Russia's economy, the sanctions placed by the West onto those countries, all weigh on European stocks. So, looking at Euro stocks from a medium-term perspective, that's quite attractive for buying around this 353, 400 region. But the question is will it turn around here? Now, if the Russian-Ukraine crisis carries on getting worse, there's no reason why stocks can't keep falling further. So if you do buy into this area, be aware that we might have another leg lower. So this is only for medium-term buying, and you can see that price is now back below the COVID-19 falls area from February 2020, March 2020. Right? So European stocks are falling high, and those falls in European stocks are being echoed by this surge in oil prices. Now, the latest news was that Russia may put an embargo on, US might put an embargo on Russian oil. That caused oil markets just to spike from the open. Now, also look at commodity prices. Do you see here iron ore prices surging? And you see coal futures prices surging. These are two big exports for Australia. When they surge, that tends to help the Australian dollar. So we are seeing some weird reactions in markets at the moment. But those surging in commodity prices is helping like the Aussie dollar and the New Zealand dollar higher. Gold is moving higher. Now that's I did an article on this today. The reason gold prices are moving higher is that inflation expectations are high, but growth expectations have been falling. So we've seen real yields falling. So all of that is supportive for gold. If you're unsure of this, check out my Twitter feed. You see I put a post on my Twitter feed. It's at Giles Cochran CCA, and I wrote an article about that. I'll just show you here. You can just see here. See my latest article explaining what's underpinning gold price right now. It's just there at Giles Cochran CCA. I'll let you read that in your own leisure, so you've got plenty of time to look at it. But the bottom line is, if we see more risk-off trading in the current environment, that will support gold upside. And in current market conditions, any retracements back down to that 1950, 1960 region is supportive for buying. Okay, so if we see price move back down to this region here, that 1960 region, you'd expect buyers to step back in. Stocks can be just placed the other side of that 1940 region. Now, if there's a de-escalation in the Russian-Ukraine crisis, gold prices will fall rapidly lower. So that's only one to trade if the geopolitical risk remains elevated. Oil prices should remain elevated as well. There's a lot of volatility in oil markets, so you're going to be very careful about chasing those markets at the moment. Now, despite the risk-off trading, you see the bids come into bonds from last Friday, seeing a bit of a retracement now. Remember, when markets are worried, you see bids into bonds. So bids into bonds is when you see the yields drop, because the price of a bond and its yield are they run counter to each other. So when a bond price rises, its yield falls, and when a bond price falls, its yield rises. So here you've got bond prices rising, which means the yields fall. This is risk-off trading that we're seeing at the moment. See from last Friday. So bonds have been bid on the risk-off trading that we've had, the further escalation of Russian-Ukraine crisis, and bonds have generally been lower. Now, this is the reason we can expect the Japanese yen to remain a bit weaker. Now, let me just show you something. Like, what you notice is normally, when you've got, like, this is just currency strength for like today. Normally, when you've got risk-off trading, you'd expect the yen to be strong alongside the Swiss franc. But you notice how the yen is one of the weakest currencies on the day. And let me explain what's going on. The yen does not like high oil prices. I'll show you that relationship here, right? Now, this is the yen. Now, if we overlay, I'll just see if I can add a overlay onto this. I'm not sure I can. Let's have a look. Hang on. I want compare. Let's see if I can just put US oil. Okay, I've temporarily lost how to overlay oil on the chart, but what you can see is, what I'll do is I'll try and overlay. See, there's to see if I can do this. Right, okay. Apologies, I can't do that at the moment. I've just temporarily lost how to add there's usually a tab up here about adding a overlay chart, and normally I just do it. I normally do it one way, and that way is just sort of disappeared off the tab. Okay, so basically you can see the yen has been very weak. Now I'll explain to you the scenario. You can look it up for yourself. Now the Japanese yen, Japan is a net importer of oil. In other words, they need to import oil into their economy. So that means when oil prices are very high, it means the expense for Japan is much higher on their energy costs. So that weakens the yen. So high oil prices weaken the yen. There's also another reason for weak yen, and that is, just take a look here in these Japanese bonds. Now, do you notice these Japanese bond yields are relatively flat? Okay, now you see how they're relatively flat around this 0.216% level compared to, say, like US bonds, and this is the US Treasury, and do you see how there's been this gradual move higher in US bonds, right? So you see that this gradual move higher, but if you look at Japan's bonds, you see, look, yeah, there's been a move higher, but it's very gradual. It's only like within this 0.25 and minus 0.25% range. So it's a much smaller range. Whereas if you look at US Treasuries, you can see that their range has been much higher, like, you know, from 0.6 up to 2%. But Japanese bond yields have been rising ever so slightly. Now, what Japan has said is they're going to keep the yield between plus 0.25 and minus 0.25. So what that means is every time price moves up to this region at the moment, they're going to buy bonds. So they're going to keep the yield pressured. That weakens the yen. So the yen weakness that we've seen is due to high oil prices and the Bank of Japan's monetary policy. Also, Japan has very weak inflation. So that means, like a pair like the New Zealand dollar yen, we're expecting that to gain over the medium term. So that means medium term, and you see how unusual, like, look, we've had risk off trading on the Russian, but did you notice how the yen pair's been gaining still? So any dips, like particularly down to that 76 region, perfect for buying New Zealand dollar yen, looking to take profit around just underneath that 82 region, about 81.90. So that does look nice from a structural position, okay? And the last RBNZ rate meeting, if we just take a look here, don't forget, check out my blog, which I run for HYCM. You can see here under the Central Bank Watch, and you can just see this is the last RBNZ rate meeting on the 24th of Feb. Yeah, thanks, Stefan. Hasimran, I'm going to try that. Thank you very much. So RBNZ, more rate hikes to come. You see the official cash rate. The terminal rate is now expected at 3.35%. So the RBNZ has revised higher their interest rate expectations, and headline inflation is expected to be higher. So that's why way back in, you know, end of Feb, I was looking for going long New Zealand dollar yen from this trend line. Okay, we've moved higher from there, but that outlook should keep the New Zealand dollar yen pair bid in the medium term. Now, let's go here. Okay, so thank you, Ian. Hasimran. Ian, I'll get to that question in a minute. Stefan, try the plus button in the top left corner next to the blue quote. Right, okay, so try the plus button, top left corner next to the, thanking you. Oh, well done. Hasimran, Stefan, perfect. We got it. Thanks, folks. Right, so let's have a look here. Right, so what you're seeing is you see, as oil rises, that weakens the yen. Oil rises, weakens the yen. Oil rises, weakens the yen. Oil rises, pushes the yen. So US oil here is this one. So rising oil pressures the yen. And look, when oil falls, that gives the yen strength. Now remember, Japan is a big exporter. Think of all the cars, you know, Toyota, etc., etc. So when the yen is weak, that's great news for Japan because their exports are less expensive. And if oil prices are falling, that means they're producing for cheaper. Okay, so it's even better, and that's sort of more supportive for the yen. So this surge higher in oil prices just pressurizing that yen. Now, obviously, that can change if the Russian-Ukraine crisis change, but that's the relationship going on at the moment. Now, coming up this week in terms of risk, most of the risk events are going to be calendar events, are not going to be important as long as that geopolitical risk remains. But the most important event is going to be the ECB rate meeting. Now, this is interesting because the ECB meeting is on Thursday. Now, if we were sort of doing this seminar like a week ago or 2 weeks ago, what we'd expect from the ECB is them to announce the end of emergency asset purchases in March, which is what we can expect anyway, and maybe them hinting that asset purchases, that's QE more generally, would end around September, third quarter, or maybe even fourth quarter this year, and that interest rate hikes would come this year. Now, the last inflation print out of Europe was last week, and it was high. It came in at 5.8% year on year versus 5.6% expected. That's going to worry the ECB. But at the same time, as you've got rising inflation, you've got slowing growth expectations as well because of the Russian-Ukraine crisis. So the ECB this Thursday are most likely to stay on hold. They're unlikely to signal rate hikes this year, and they're unlikely to signal the end of asset purchases on the third or fourth quarter of this year. So all of that means that this pressure we've seen on the euro, and the euro as a whole lost around 7.5% since the start of this month. So the euro should remain pressured. Now, with that being said, should this Russian-Ukraine crisis fade, then euro-US dollar is a very cheap value, and euro-yen would be a great way to trade out of this. So say Russia suddenly announced that we're going to withdraw Russian troops, that's the end of the crisis, then what we'll be looking at is something like euro-yen upside would make enormous sense. Okay, that would be a great pair to trade if we see a de-escalation of the Russian-Ukraine crisis. But we need to see not just the idea of peace talks between Putin and Ukrainian President Zelensky. The market's got tired of that because what's happening is President Putin's offering what's called a Roman peace, a Pax Romana. And that was the policy that the Romans had before they would invade and destroy a village or a town as they made their way across Europe. They would offer the inhabitants of the town or village a Pax Romana, a Roman peace. In other words, submit to Rome and let us do what we want and become, part of the Roman Empire, and then we'll give you a Roman peace, right? And that's really the way that the discussions are going with Ukraine. Is Russia saying, we want to give you a Roman peace that, as long as you do what we say, become part of Russia, then we have peace. So that's the issue. So the markets got tired of the headlines about Russia and Ukraine having peace meetings because they're not seen as being legitimate ways that both parties will happily agree that a peace has been found. You understand what I mean? So as a consequence, a de-escalation would be definitive news that Putin is withdrawing troops from Ukraine, or President Zelensky says, at last, there is a new dawn for Ukraine, you know, we've found a solution. That's the kind of thing. And then we'd expect euro yen to rapidly rally higher. And also, we'd expect European stocks to surge higher. So all of a sudden, the stocks that would be really good value is the DAX, FTSE 100, Euro stocks. All of these would be buy-up markets if we had that de-escalation. You'd expect downside in gold and downside in oil. The downside in gold because real yields would rise, and you'd expect gold to fall, and you expect crude prices to fall as well because there would just be relief that Russia's oil supply comes back into the market. And you'd also expect some of these commodity prices to drop. So the euro has a problem because how does the ECB manage this monetary policy statement? Now, prior to this meeting, what the market was expecting was that the ECB would kind of indicate that, okay, you know, we've got high inflation, we're going to have to hike interest rates more quickly. But now, if they hike interest rates quickly, they'll just risk slowing growth even further. Do you see the problem? So the ECB have to be cautious. In other words, we might find that the ECB monetary policy statement is very neutral, and the ECB just play for a bit more time. So that's why going into the meeting, we've got a neutral bias, because a lot of this euro selling, that's very overly sold. We're moving into that key support level. If the crisis gets worse and escalates, we'd expect sellers on rallies in the euro. And also that euro weakness has been prompted as well by this dollar strength. Remember, if global growth is expected to be impacted, which it is, that tends to be dollar positive, because dollars come back into the US when the rest of the world's slowing down, because there's less investment opportunities. So that tends to bring the dollar stronger. Also, stagflationary fears. And remember what stagflationary fears are. I'll just show you here. It's slowing growth and rising inflation. Let me just show you a quick screenshot of that. Here we go. Right. So stagflation is what the market's concerned about. It's when you get high inflation. Think of the inflation in the US over 7%, in Europe just under 6%, in the UK is expected to rise above 7%, right? Inflation's high, but growth is low. So the Russian-Ukraine crisis is even weighing further on growth. And you see what's happened with oil prices, commodity prices? That increases inflation. The reason that increases inflation is because energy, almost anything involves energy. If you're producing something, you use energy. If you're transporting something, you use energy. So higher energy costs, higher commodity costs, end in higher prices, which is inflation. So this stagflation environment suits gold long, tips, oil, the dollar. Right? So make sure you got that. So that's what's going on. And the Russian-Ukraine crisis is making that stagflation view even worse. Okay, that's the issue that we've got. So that all of this means the ECB are more likely to be cautious on Thursday. Now, should they be more aggressive, then you expect a little bit of euro upside, but you expect that to be faded, because all of a sudden the market will straight away remember, oh, hang on, we've got this Russian-Ukraine crisis. That is bad, and expect any rallies to be sold. We'll cover that in more detail on Wednesday, so don't miss that. We'll get into that in more detail. And then Friday, we've got employment change data coming out of Canada, and yeah, you know, that's the main issues that we've got coming up. In terms of currencies, just a couple of other things to point out to you. The Aussie, New Zealand dollar and CAD would not normally be strong on a risk-off trade. They are because of commodities. The Australian dollar, the New Zealand, remember CAD is supported by oil. Aussie supported by those iron ore coal futures moving higher. Remember here, see there's iron ore prices and coal futures, that supports the Aussie very nicely. And the New Zealand dollar is also moving high, probably in sympathy with the Australian dollar. And then the Swiss franc and the yen are the weakest currencies of the day, which is odd. And the euro and the pound are both weak because of their proximity to Russia. So that's what's dominating markets at the moment. Strong dollar on risk-off trading and on geopolitical growth, strong CAD of oil prices, strong Aussie dollar on commodity prices and the New Zealand dollar, weak yen on high oil prices and the Bank of Japan monetary policy, weak Swiss franc as well. Reasons are slightly unclear, but Swiss National Bank is starting to get, there's been a couple of comments from the Swiss National Bank about their concerns regarding the euro-Swiss franc pair. Now, the Swiss National Bank hate a strong Swiss franc, and they've had a couple of comments out saying that they're very concerned with the euro-Swiss franc at parity. So that parity is when 1 euro equals 1 Swiss franc around this region here. Now, this isn't tradable, but look out for it. Okay, look out if you suddenly see some headlines that the Swiss National Bank are intervening. The way they intervene is by buying euros and dollars, so you expect the euro-Swiss franc to spike higher. So just look out for that. If you've never traded with a new squawk, I'll send you details of a new squawk that you can access, and you can. That's as part of my role with the financial source and analyst. You can also get some access to this via the broker HYCM, and I have various deals that can be accessed there. Now, Ian just says, going to some questions now. Hi, Giles, don't forget, put questions in the Q&A box and I'll get to them now. Hi, Giles, Ian says, hi, Giles, followed you since subscribing to Financial Source. Excellent. Just open an HYCM account with your Telegram link. How do I have access to CSNACs? Ian, ask your account manager and say that you would like a free trial of CSNACs. And just say, if you stress your relationship with me, you can say, try and take full leverage of that relationship is what I'm saying here when you speak to your account manager. Oh, Massey, very nice. Really appreciate these webinars, Giles. Thank you so much. Massey, you're very welcome. And don't forget, ask questions. Is there something you don't understand? Is there something you want to understand better? Just ask away. I am here for you, right? And I will be back here on Wednesday for the ECB meeting. And also, don't forget my blog, right, which is here. And I've got a lot of information up on this blog. And I try to keep on top of central bank decisions. So a couple of things to, which I consider like really good value is the trading calendar events. So I will have like, how to trade this meeting, and it gives you a good sense of what the market's expecting for those meetings, right? So make sure you check that out. Check Central Bank Watch, and any ways you can help me is by just sharing it on social media. So any of my posts that I put on here, if you just like it and share it, that's just a way of helping me, and that helps me do these webinars because I get more profile, and obviously the more profile I get, the more I can do these kind of webinars basically. Okay. Folks, that's great. Thank you for the kind words. Hasimran and Stefan, thank you very much for pointing out that plus symbol. You've taught me something about TradingView, and I do appreciate that. Ian, I hope that helps. Any problems? Massey, glad to help. Stefan, great point. Are we closer to de-escalation or World War III per the markets? Right, Stefan, that's a great question. Markets are saying we're closer to a de-escalation, but it's going to drag on growth. That's what that heavy selling in European stocks is telling us. So yes, let's just look at this, right? All right, let me just show you. Let's just pull this out. Right, that'll do it. Let's open image in a new tab, right? Right. Okay, so Russia's beef is that when they were originally told NATO would not move past Berlin. So as NATO, blue countries, has expanded east, Russia feels threatened. You can see Estonia, Latvia, Lithuania, very, very hard for Russia, has NATO countries on their border alongside Norway, right? Now, the problem with NATO, from a Russian perspective, is that if, say, if Russia had some beef with Estonia and you know, had a conflict, because Estonia is a NATO member, that would mean an attack on Estonia brings in all these other countries plus the US. Terrible from a Russian perspective. So Russia feels tripped that NATO has expanded to the east. Ukraine is a pivotal country. If Ukraine turns to NATO, Russia feels very, very frightened, because from a Russian perspective, it impacts their security. Ukraine, some within Ukraine would like to join NATO, some within Ukraine would prefer to be part of Russia. So there's a conflict within the country to a certain extent. Now, what this means with Russia moving into Ukraine, Ukraine is not a NATO member. So Russia is, in one sense, able to make an invasion into Ukraine without triggering all these other countries on their back. The last thing you want is Britain, France, Germany. That would be your World War III scenario that Stefan has outlined to us. Now, what does the market think? The market thinks, at the moment, is pricing Russia's going to stay in Ukraine and Russia's going to be sidelined for the foreseeable future. That's going to bring Russia into a recession, and there's a possibility it drags the Eurozone into a recession as well the longer it goes on. So if it's a long, protracted, drawn out affair, Russia will go into, it's very sad, poor Russian people, you know, potentially, you know, decade or so of suffering, weak economic growth. It's terribly sad, okay? And oh dear, and then the Eurozone may be dragged into a recession as well because of the trade, the links with Russia, and the connection between Russia's energy markets. About 40% of natural gas is supplied to Europe from Russia. Now, Russia have never, I don't think they've ever cut off gas to Europe. They certainly didn't do it during the Cold War, because it makes sense. Like, why are they going to cut off their money supply? You know, if they cut off Europe's power supply, they're just hurting themselves, okay? So I think it's unlikely they'll do that. So the market is expecting them, Stefan, to just try and take Ukraine. But I say just take Ukraine because it's going to have impacts. And that could also slow down the US as well. So would the US be slower to raise interest rates? Would the US even go into a recession? So sadly, it's really bad from a global growth perspective. Now, how it's going to plan out, I don't know. No one knows the future, right? But it looks like a drawn out, slow affair that's going to be a slow drag on growth. So what that means for us in practicality is be careful about buying these dips. They may be deeper. So from a like 12 months perspective, these dips in the DAX, Euro stocks, FTSE look quite good value. But in the near term, might be just worth waiting a little bit, just seeing if the markets maybe haven't quite bottomed yet. Yeah, Hostimran says, have you heard about the meeting between Russia and Ukraine and the demands made by Russia? Could this be a turning point in the developments on the geopolitical side? Every meeting could be a turning point. It's just that the announcement of a meeting itself won't be. Do you see the distinction, Hostimran? So at one stage, when it was Russia and Ukraine agreed to peace talks, the Aussie yen was rallying on relief. Now, Russia and Ukraine agreed to peace talks, no reaction. Why? Because nothing's expected necessarily. But if that changes, yes. So what you've got to do, Hostimran, is clever and only react when there's a definite piece of news. Okay, folks. Thanks to everyone's input. Thank you very much, Hostimran and Stefan, for pointing out how to overlay that oil chart on, and hope it's been a good session. Thank you for your input, one and all. And don't forget, back here on Wednesday for the link. Don't forget, just follow me on Twitter for the link. I normally post up the link just before. Take care, everyone, and look forward to speaking to you soon. Goodbye.